more complex parts of the buy-to-let market. We covered a lot in session 1 about residential, adverse credit, self-employment. This is kind of the second step towards getting that knowledge up, if you like, if you need it, or more so just a reminder about kind of some of the key elements of our industry that could to really support you as an advisor, but most importantly help clients. So like I say, treat it as you want to. Hopefully it will give you some little hints and tips. Hopefully it will give you that introduction that you need, and then you never know, you might gain something and think, actually there's a case for me there as well. Just for the guys that weren't on last week's session, just to remind you that my job, if you like, or the organisation that I work for has gone through some pretty big changes, to put it bluntly, over the last couple of years. But we combined to make a super specialist lender, if you like, in October 2019. So Precise Mortgages, Kent Reliance for Intermediaries, and Interbay Commercial came together. From your perspective, you're still going to get the great support you always have had from your business development managers for Precise, Kent and Interbay, all separate people, all separate organisations, all separate underwriters, all doing something that could mean there's a solution for those specialist clients out there. And that could mean anything from bridging finance, buy-to-let finance, complex residential, self-employment, adverse credit, all these things that we can basically play around with across the brands that we've got out there. So today you will hear me kind of talk a little bit more about Interbay. I'll refer back to Precise and Kent Reliance as well, but ultimately just giving that kind of flavour of what we can do as a group of lenders. Again, just to kind of illustrate where we sit within the marketplace, those 3 lenders, if you like, if you combine them, we're probably one of the top 10, 15 lenders in the country. So we've got a fair bit of strength behind us. It does mean we can kind of play around with how we do things. Sometimes we might go down the more bespoke underwriting process. We maybe Kent Reliance or Interbay. Sometimes we might go down a more simple format, if you like, with Precise Mortgages, where as long as you hit the right boxes, then hopefully we get you those deals out a bit quicker potentially than we might do with something that needs a little bit more thought. But ultimately, all working in that specialist sector, all very much working, depending on which way you look at it, either in partnership with your high street lenders to go, actually, how can we support a client get to that high street? Or maybe when it comes to buy-to-lets, how can we offer something completely different from the high street because of our flexibility and because we can look at, say, a buy-to-let mortgage in a completely different way than a high street would, with the complexities of what's happened over the last kind of 20, 25 years, which again is something I'll talk about at length today. Again, specialist lending for me could be anything from self-employed credit impairment, which we talked about in session 1, right through to those kind of more complex parts of the industry, when for me, it's got to be buy-to-let. So portfolio lending, limited company, which is a real kind of growth market within the buy-to-let space. And then obviously what's happened from an advisor perspective, from a lender's perspective, but also how that affects the client when it comes to regulation and taxation as well. So, and just making sure that you feel, I suppose, for want of a better word, nice and safe with your advice process. I don't know, obviously, Becky and the training team and compliance team, HLP, will support you with that, but it's just understanding that you're not crossing the line and giving tax advice potentially when it comes to buy-to-lets. Property refurbishment, or maybe properties that are maybe failing an EPC, and again there's lots in the press about that as well. We'll touch upon that within this session. So yeah, today very much about the buy-to-let sector, how it's kind of rising and growing as a sector, but also really important to understand that I have to be really clear, is that I'm not a qualified tax advisor or an accountant. So these slides really are for, I suppose they're for education purposes, yes, but these are topics. These are ways for us to look at how we kind of currently understand the regulatory changes that have been put into place, how we can maybe support you with understanding where to stop that conversation if it gets too much, in terms of your client thinking you're giving those angles towards tax advice as opposed to just mortgage advice. We know, and we very much understand, I'm sure you can kind of back me up on this one, but each applicant's circumstances are going to be completely different. And if they do need that legal advice, tax advice, then ultimately you're going to push them in that direction as opposed to you crossing that line. But we, and as you as an advisor, are enabled to provide advice on that particular part of what we do. All examples that we feature within this presentation are very much for fun and illustrative purposes only, but none are intended to give tax advice, and that tax advice should be sought by the customer where appropriate. On that note, I think we mentioned it in the first session, but the ICAEW great website and finding independent tax advisors within your locality. Again, I'm sure Becky can support me with saying actually that might even be a step too far in terms of recommending an individual, but telling the customer to go somewhere and finding out where they can find a tax advisor. Then the ICAEW is a great website to do that as well, because that's going to take that stress away from you. So very much so I look at buy-to-let mortgages as that, I suppose, that iceberg. We can see the lovely rates that some of the high street lenders offer. We can maybe see how lots of different lenders, even new lenders coming to market now, lots of new buy-to-let lenders coming to market, even some that used to be back in the past have now come back to fruition again. But what's lurking beneath the surface? Is there things that I need to be watching out for? Is there things that I need to really understand that's going to protect my advice and going to give that advisor the best support they need? So again, it's just an interesting concept to how we discuss buy-to-lets. If we're in a classroom situation, if you like, we might have a bit of fun with this. We talk about why maybe a client looks to invest in buy-to-lets, maybe what's changed, and maybe how you or how we can support those clients, those landlords in the marketplace that we're currently working in. So again, like I say, apologies, this is virtual. I will talk these through, but these are kind of answers I want you to be thinking about in your own minds about when you sit down with a buy-to-let landlord. Are you asking the right questions? Are you giving yourself time to provide that right advice? So again, just starting with why. So why does a landlord invest? Might sound pretty silly, but ultimately there could be a main reason. So giving yourself that time, asking that right question could really support how you're going to structure that deal. So it could be a secondary income. It could be that they're wanting an income right now, savings rates particularly low at the moment. Could it be that they want that buy-to-let in order to give that income right now, support or supplement what their main income is from employment or self-employment? Again, that's going to help you in kind of taxation as well. So if you pass it over to that tax advisor, they'll talk about how to best structure that. Retirement income, really interesting one. So at Precise Mortgages, for instance, we can accept a landlord at aged 80. We can even offer them a 35-year mortgage term. So if that deal completed before they turned 81, then ultimately they've got a 35-year mortgage deal on the table. That could give them that retirement income that they really, really want. So again, why, Mr. and Mrs. Customer, do you want this buy-to-let? Well, I want retirement income. That could mean that you're not looking at maybe a high street lender that might kick them out at age 70, 75. And it could be you go down the specialist route and look at someone like Precise Mortgages. I think the family planning bit is quite an interesting one as well. So maybe buying a property for your child's future. So again, both Precise, Kent Reliance, Interbay, and probably a whole host of other specialist lenders as well. They could potentially look at structuring a buy-to-let property in a limited company structure and maybe having your children as 100% shareholders of that limited company. So again, there are solutions, but understanding the real kind of crux, if you like, of why that landlord wants to invest, then leads you down to where you can find that best advice. Could be capital growth. So lots of research recently has shown that people are looking further north, looking where they can buy those properties, add that value to it, as opposed to buying where I live down in the southeast, where actually the capital growth potentially isn't there, but maybe the rental value is, and that could give you the income now versus that capital growth in a different part of the marketplace. But again, how are you going to get that expertise? How are you going to know where to buy if it is north of Watford, for argument's sake? Where you're going to go to try and get those properties that aren't going to let you down further down the line. So again, does that lead to property clubs, which could be a real kind of no-no for a lot of lenders, including Precise, Kent and Interbay? But ultimately, how are they sourcing those deals and how are you getting involved? Do you understand where and what effects that could have on your mortgage application with the lenders? So then you start looking at kind of what's changed, and to put it bluntly, quite a lot. So anything from kind of right back to the 80s and 90s, where really it was nothing really happened around buy-to-lets. Often it was done as a residential mortgage, right through to kind of where we are now. Lots of changes are happening, lots of kind of ways that our industry and the regulator has tried to protect what's happening. How can we get to a position of feeling really comfortable with this market, and ultimately how we can do what we're doing currently. So it could even be right back from the creation of an AST. It meant that landlords could make a bit of profit from property, right through to that 2004 Housing Act, when we started to define what a buy-to-let property was. So residential, semi-commercial, HMOs, and commercial. So beginning to really kind of get to grips with how we made buy-to-lets profitable going forwards. And then what you found, and this will come to fruition right into January 2022, is that in June 2015, George Osborne announced the changes, probably the biggest change actually, in the announcement on tax changes to personally owned property in regards to the inability, if you like, to offset any mortgage interest relief. Now that's going to be seen when we get to customers and clients doing their tax returns in January. So in a couple of months' time, January 2022, they're going to realise they can't offset that mortgage interest. And suddenly, is that property in the right structure, if you like? Is it giving me the money that I require? Have I worked out how to pay that tax bill? Is it working for me? Do I need to sell it? Do I need to move on from it? Do I understand what's happening and how you as an advisor can maybe affect or have those calls from those landlords that say, actually, I need your support because this just isn't working for me in its current structure. And again, that's where that kind of handoff, if you like, could make a real difference. Very much stamp duty changes are really, again, coming into effect now, if you like, because you might have seen a surge in people buying those buy-to-let properties before the 3% stamp duty came into place. So let's say they're on a 5-year fixed rate deal when they bought in 2016. Well, ultimately, if they haven't bought anything since, they might not be aware of the PRA changes, maybe the stamp duty changes, the interest relief phasing out, the electrical testing that's happened. Again, what I always say to Becky and I talk about this a lot, but actually give yourself that real kind of sales pitch. All these changes you've had to be aware of. If that landlord hasn't or doesn't know that, then again, you're adding real value to that conversation, making it might be more tricky to get that mortgage they got pretty easily in 2015, for argument's sake. But now where we're at is that we are going to make sure that they can support any rental voids. We're going to look at the PRA changes to make sure if they're a portfolio landlord, that portfolio is performing, for instance. And again, we've got plenty of tools to support you with that, but that landlord might not know what's happened. If you kind of go forward a little bit, we've also got the EPC changes, a lot in the press at the moment. So if you've got an F or a G, then absolutely, it's an EPC fail, that's an unmortgageable property, and the tenants can't live in that property. But ultimately, there is a lot to talk about the government changing these EPC standards or ratings to a C. So again, something to be really aware of, because if you've got a landlord that's coming into your office or speaking to you over the phone and he's looking to pick up, say, a Victorian 2 up, 2 down, which is what I live in, then ultimately you might not be able to get to that position, and ultimately you might not be able to get that as a buy-to-let mortgage, or you might be looking to sell it by 2025. So little bits of education that you can throw into those conversations with your customers could add real value in terms of your advice process and how you can support them going forward. So yes, lots of changes, lots of things have happened. Again, positive, negatives. Positive is that ultimately the more changes that happen means they're more likely of a customer picking up the phone and asking for your support. So that's a massive positive. You imagine someone that's looking to set up, I don't know, a limited company buy-to-let with their children as 100% shareholders. In reality, they're not probably going to do that directly with a high street lender. They're going to be coming to you, the intermediary market, and asking them for that support and advice. So that's a real positive in what's happened. So we looked at why they invest, we looked at maybe what's happened. Now it's important to kind of look at how landlords are maybe tackling the changes. So again, this is where you come into your own. Number one, obviously specialist advice, seeking yourselves out, seeking how you can really structure a deal to support that particular landlord with the right set of questions that have been asked and answered. Could be structure of ownership, could be joint tenants in common, could be a limited company structure. All of these things that are out there from the specialist to support what you're trying to do. It could be that you understand the affordability calculators of all of the specialist lenders out there, or even some of the high streets as well, and understand that they could differ from one lender to another. And it could mean you maybe get more loan amount, if you like, with a lender like Precise. And I'll show you that in a second as well. It could be that you utilize some of the lenders that are happy to consider things like top slicing. So top slicing, where you may be utilizing extra earned income or maybe extra portfolio income that's coming in that's surplus to all those stresses and strains that go with that portfolio, to say, actually, I want to open up the ability to look at a 2-year deal because I've got that extra income coming into my household. But again, lots of lenders that would consider top slicing. Have you considered it? Does it mean I can walk away maybe from a 5-year fix and maybe not seeing that customer, or that's just not the right thing that that customer wants to do, and then suddenly bringing back in a 2-year deal, using that extra income, getting them on a 2-year deal because that's the right thing for that customer. Understanding I can't necessarily go to every lender for that particular part of policy, if you like. Then you start looking at portfolio diversification. So is it then start looking at multi-unit properties, HMOs, maybe even holiday lets? And again, we can talk about that. What landlords are particularly good at is looking at getting the most yield for their money, if you like. How do I kind of grow my business? Because ultimately buy-to-let is a business. How can I do that? What's the best way? What's going to give me that extra income that I need? Then you start looking at things like types of tenants. That's really important when it comes to your questioning, because if they're going to put 15 students into a property, is that going to affect the ability to go to certain lenders? Equally, is it possible with the local authority that I'm living in? Is that going to have a detrimental effect? Can I get a license if it's a HMO on it? And again, we'll touch upon that a bit later within the presentation. How are they sourcing the investment property? Mentioned it already, but are they jumping a Rightmove, or are they actually using a property sourcing company? We might get a bit nervous about that. We might think, actually, we just need to really understand how they're sourcing it. Is it the right thing? Is it a new build, high-rise development in a city centre, for instance? So at both Precise, Interbay, and Kent Reliance, for instance, we have, well, I deem it a naughty list. So a list of properties across the country that we just don't want to lend on. Ones that have maybe been pushed towards investment only. So if I'm, as a lender, if you like, looking to lend on a property, and every single unit within that high-rise development in central Leeds or Liverpool, for instance, is going to be aimed at a landlord, then ultimately it could really have a detrimental effect that there's no actual owner-occupiers. There's no people that are looking to live in that property. There might be guaranteed rental yields, for instance, for the first 2 or 3 years. That's the kind of stuff that's really going to put us off as a lender. Those are the kind of things to have those conversations with us, especially if you don't know the area. So you're down in Essex like me, and someone phones you up about a property up in Leeds or Liverpool. I don't know that area at all. I've got no idea if that's going to work for that as a lender, but also as a client as well. So again, utilize the skills within the lenders that you can lean on. We're there to support you. We're there to help you. I'll talk about deposits a bit later on as well. Different ways of maybe taking money out of maybe a self-employed business to utilize as a deposit on a buy-to-let. But it could equally be gifted deposit from family members, for instance. It could be that you're buying a buy-to-let from a family member. And again, Kent Reliance could be the answer on something like that as well. So lots and lots of solutions. I think this is really important as well, just to kind of get a grip to kind of where you fit within the process. Obviously, your mortgage advisors, you're giving the best mortgage advice you possibly can. Then you've got your accountants, and then you've got your tax advisors. And I think it's important to separate those two people. So your accountant, again, is that person for me. Covered it in last week's session. They're looking back in time. They're putting those figures together based on what happened last year. Your tax advisors, however, they're the people that are looking forward in time. So when you're looking at a buy-to-let, and this doesn't need to necessarily be in a limited company structure, even in personal name, a tax advisor can give advice on that as well. So can they help structure that in the right way, that when that client comes back to you, you can give the best advice to say, right, okay, what's going to work for you? I need a personal ownership mortgage. Fine, perfect. Then I can go to the high street. Are you a portfolio holder? No, I'm not. Right, it's probably going to be a high street deal. Or I'm a high rate taxpayer, additional rate taxpayer, so is my wife, for instance. Then do I need to actually structure this purchase, or this first or second or third or fifth or 100th purchase of a buy-to-let in a limited company structure? Now, if I do, again, I'm getting that advice from the tax advisor, coming to use the mortgage advisor, and then I'm saying, right, perfect. I've got these 3 or 4 lenders that will do that. These are the best rates for you. These are the best deals for you based on what you've been told by a tax advisor. So that point is really important. The solicitor can help as well with that structure. So let's say it was a personally owned structure that you took advice from your tax advisor on. You could even look at maybe tenants in common, or splitting it, 99 to 1% ownership. And again, your solicitor can help alongside your lender with that, alongside the tax advisor. So looking at tenants in common or joint tenancy, again, a really interesting part of something we probably did when we did our CMAP qualifications. but now suddenly comes to fruition again when you start talking about buy-to-lets. Letting agents, again, crucial part of the jigsaw puzzle. Lots of research done that actually letting agents will guarantee you, but they will generate more income for you as a landlord. Potentially make sure that there's little or as least amount of rental voids as possible, but also understand the local market. So understand if there is a market for students, if there is a market for professional tenants, for instance, or families, whatever it might be, they're going to support you with that process and ultimately maybe take the strain away if you're not going to run it as your own company. So I suppose the first part I want to talk to you about around maybe not just falling into the trap of all buy-to-lets need to be in a limited company structure. I think that's a really important part to talk about first and foremost. ICR calculations are something we talk about a lot within the buy-to-let sector. So interest coverage ratios, in essence, that we're covering enough from the rental income to cover your tax position, if it's in personal ownership, or any rental void. So we've got enough, I suppose, disposable income, if you like, over and above what the minimum rent would be to cover that mortgage payment. Have we got enough in place to kind of cover what we're trying to do? So what Precise do, what all lenders do, they'll look at the annual rent, they'll look at the loan size, and they'll start kind of working it through from there. How can they get to a position of giving you that 80% LTV loan, 75 or even 85%, depending on which lender that you go into? So you look at the rent, you look at the loan size, you then start looking at the assessment rate. Is it a 2-year deal? Is it a 5-year deal? What, again, are the stresses and strains that the PRA are putting onto us? And then you start looking at what tax position or what's the income of my applicants. Are they basic rate, higher rate, or additional rate, or are they looking at a limited company structure? Just for the moment, let's just stick to personal ownership cases. So this is in essence, the heavy lifting that goes behind a Precise calculator, where you're looking at the rent, looking at the loan size, looking at the assessment rate. Is it 2 or is it above? Is it a 5-year deal? So under the PRA rules, they allow us to stress it on a 5-year deal. So that's why you see so many deals at the moment, or probably over the last 5 or 6 years, going through as 5-year deals. So the ability to get that loan that customer requires, because we can stress it at the 5-year pay rate. But anything less than that, we've got to put these extra stresses and strains in place. We've got to look at the tax position of our applicants to see where we can get to from that perspective. So to bring it to life a little bit, let's look at our kind of what our calculator looks like. So in essence, this customer is looking at a property, 400,000, gross rent per month is 1,150, and they want a loan amount of 300,000. So property value pretty high, loan amount pretty high, but ultimately the rent is pretty low. So you're not getting, you've got the capital value, but you haven't necessarily got that rental value that's coming through. You then start looking, is it a 2-year deal? 2.83 in this example. These are historic rates, I should add. And then you start looking at the reversion rate as well. So what's going to happen after that 2-year deal? Our calculators would always assume that's a 5.5% rate. So again, even if you put 3% in there, it would still revert to that 5.5 in our calculations. Again, doing that heavy lifting for you, but you can take this information directly from our product guides. The important bit for this calculation, this kind of example, is that on the right-hand side, you've got ownership. So single applicant in this case, high rate taxpayer, so they're earning more than 50,000 a year. You've divided that by 12. That's really important. So that means you're going to be looking at a 145 ICR calculation. That's going to be pretty much industry average, if you like, across all the lenders that are out there. So in this case, they want 300,000. They're only getting to a loan amount of 170. So nowhere near, you could argue, to where they want to be, based on their tax position and based on that ICR calculation. Where Precise differ slightly from a lot of the specialists, I think there might be one other lender that might do something similar to this, but ultimately we then say, well, hold on a minute, can we add a second applicant in? Is there someone in the background that you as a broker or the client just didn't know about to add into this calculation? So what I've done here is to just change it to 2 applicants, second applicant, maybe at home, not in a job at the moment, no need to work, hasn't got a tax liability, is not paying anything towards that household, if you like. So ultimately has got more income to be gained before they start paying tax. What Precise would do then is they'd offer a blended ICR calculation. So they look at the tax position of applicant number one, so they're a high rate taxpayer earning 50, applicant number two earns nothing, and they go, actually, we can give a blended ICR rate of 127 across the two of them. So by doing that, you've then got potentially joint tenancy into play or tenants in common. Now, ultimately, again, I'm not a tax advisor, but your tax advisor might say, it makes sense to do a share of this property. Could I do 99% to applicant number two and 1% to applicant number one? Because ultimately, applicant number two has got no income. So the more of that 1,150 rent that's coming into this property that goes to applicant number two, then we can get up to that position of utilising their tax banding to make sure it works for them. So two things, you're going to get a bigger loan amount by looking at these calculations and see if there is going to be a blended ICR. So compare us to some of the high street lenders in that case. We're probably not going to compete on rate as a group of specialist lenders, but ultimately the loan amount could be, again, to why an investor wants to invest, that could be the most important thing. Getting the most amount out of this property to give them more savings, if you like, or keep that money back for future purchases could be more important than that better interest rate. So now you're at a higher loan amount than you would potentially get from the high street. So rather than being 170, you're now at 197. That's a big difference. It's still not where you want to be though. So ultimately, just have a think about this, understand joint tenants versus tenants in common, know that this is something you can work with the solicitor and those tax advisors to get to that position, and just get comfortable with it again from an advice perspective. Just be careful about getting excited about doing these as a remortgage opportunities. What the government don't particularly like is when you've ultimately changing something to pay less tax. So just be careful with that. But on purchases, a very, very good time to have these conversations. To get to 300,000 though, all I've done in this last screen is just change it to a 5-year deal. So again, talking about those PRA changes, because we've got the ability to stress it on the 5-year rate at the pay rate. Now I'm going from that 170, 197, and I'm going right up to the 300,000 I require because I'm putting it on a 5-year deal, because I'm stressing it at that. Again, some options there for you. And then the final option, if you like, mentioned it in one of the screens earlier, but we can look at top slicing. So like I say, in this case, you've got applicant number one here, higher rate taxpayer, maybe he's got no residential mortgage or a small residential mortgage, maybe got a limited amount of costs going out, then absolutely top slicing could be a solution to keep it on a 2-year deal. Now, actually, top slicing actually offers the lowest ICR calculation, so that means we're only stressing 110% ICR. So again, good solution. Our calculator's doing all that heavy lifting for you though, so you're not going to have to get your calculator out to do this. Just lean on our calculators. That's going to support you ultimately do that decision in principle to see where we can get to. We're going to have a real kind of deep dive into this client to see if top slicing is available, but that's going to be very similar across lots of other lenders that do things similar. So lots of different options, lots of different solutions. You've got to utilize the lenders that are out there. Okay, so we've talked about personal ownership cases. We've talked about the ability to maybe borrow a little bit more through bespoke ICR calculations or kind of understanding that side of what we do. The alternative, obviously, and there's been a big growth in this sector, is limited company structures. So I want to buy a buy-to-let property in a limited company SPV, so a specific purpose vehicle for buying buy-to-let properties. Very simple to set up a limited company SPV. Most lenders would require a personal guarantee from potentially all the shareholders and all the directors. So Precise would, for instance, Kent Reliance would only need personal guarantees from the majority shareholders or directors. If you've got a minority or lots of minority shareholders within that business, again, they're not fussed about them. They would just take it from the majority. So again, a little bit more flexibility depending if it's a new company or an existing one. Bit of flexibility on where you go and which lender is going to support you from my group, if you like. So another company, pretty simple, take you about 20 minutes, half hour to do so. Hardest bit is probably finding a name, but also setting up the business bank account that goes alongside that limited company. So a lot of online companies will do this now. Starling, even Metro Bank from a high street lender. I think they offer it pretty quickly now, but some of the more high street lenders often can take 2 or 3 weeks to set those business bank accounts up. Just be aware of that because that could slow down the application process to the lenders as well. I've got trading businesses on here just as a kind of interesting thought process. So there are lenders beginning to come into this space to lend to a trading business. So if you run a self-employed mortgage business, then that is your trading business. If you have done particularly well over the last 12 months and ultimately you've got a bit of money sitting within your balance sheet and you're thinking, what am I going to do with that particular amount of money? I'd like to invest it into buy-to-lets. There are going to be certain lenders that would consider that. But Precise, we wouldn't. We'd want you to take that out of your trading business and set up a newly formed limited company to utilise that income to buy a buy-to-let property. But you can do that through something called an intercompany loan. So taking it from your trading business, so I don't know, John Mann Mortgages, and you putting it into your new trading business, your new limited company business, which is your buy-to-let business for specific property. That works for us. So an intercompany loan between the two. And it also means now you've got a buy-to-let sitting outside of your trading mortgage business. Really important, because if you ever want to sell your mortgage business, you don't want to be selling it with the buy-to-let that you actually want to keep. Again, coming back to, why do I want to invest in buy-to-lets? Is it because I want to keep this into my retirement to keep that income coming through to me? So again, just understanding that there are ways to solve the puzzle, if you like, but just always going back to why, Mr. and Mrs. Customer, do you want to invest in this property? So yeah, deposit can come from that trading business. It can come from savings. It can, Kent Reliance, for instance, can even consider it if, I don't know, mum and dad are looking to sell property to son or daughter, maybe gifting that property or leaving it with it gifted equity even. Again, that's something we can consider across our group. It doesn't need to be for an experienced landlord. So again, we've talked, I think, in session 1 about first-time buyer, first-time landlords. Set it up as a limited company, absolutely fine. We have got some SIC codes, so standard industry classification codes. This is the DNA of a company. So these are 3, again, most lenders would look at these 3 as the main 3 for us to look to lend to. So 68209, 68100, 68320. Kent Reliance, a lot more flexible. So if you've got more than this, and there's a reason why they've maybe added on different SIC codes, they can consider it. Precise is very precise in so much as they want these 3 or at least one of these 3. If they've got more than this, we may question that we don't want to do the deal anymore. So this is an important part of that structure about understanding how they've set the business up. Is it historical and you're looking to remortgage it to Precise or Kent Reliance, or are they setting this up day one? If it's day one, I would not really expect to see anything more than at least 1 or 2 of these, maybe all 3. If it was a building company in the past and now they're looking to turn it into a buy-to-let business, again, that might not be a case for Precise, but it could be one for Kent Reliance or Intervay. The interesting bit with all of this is that any buy-to-let case you've got, certainly if it's a remortgage limited company deals, this means that you can go onto Companies House and search out what SIC codes you've got against that company. That's going to save you so much time with the lenders that you're dealing with, because you can say, actually, I've done my research. They are a limited company SPV. They're using these SIC codes. Happy days. You've got no concerns. Last thing we want you to be doing is sending a case into Precise, for instance, and it's got too many SIC codes and it's not going to be one for us to lend on. And that is one of the top 5 reasons we decline buy-to-let mortgages at Precise, is because they've got the incorrect SIC code. So again, just something very simple, ways of kind of looking at how we can do stuff. So I mentioned intercompany loans. We've got lots and lots of information within the Precise and Kent Reliance websites about intercompany loans. But this, in essence, is you've got to have a mirrored shareholding. So if I've got my trading business, or in this case, Rogers Electrics, trading business, and we've got Roger and Katie as the shareholders and directors, I'm looking to take money out of that electrical business and put it into a newly formed limited company. The shareholders, Roger and Katie in this example, have to be exactly the same. The intercompany loan is set up by an accountant, and in essence, there is a nominal rate that the government insists on. It does change. I think it's about 2% at the moment, 2.25 maybe, but ultimately that does change on a regular basis. It could be that that's the way you do this. You set it up. Us at Precise, for instance, or Kent Reliance, would need to see the details that are attached to this. What's happening? How's it happening? But it could be a brilliant way of taking money out rather than lending as that trading business to that electrical company. Buy-to-lets are complicated. They can get really complicated when you look at structures of ownership. So if you look at, for example, that intercompany loan example, in that case, I've now set up a newly formed limited company, but I might want to set up a newly formed limited company with my trading business, so Roger and Katie's electric business, as one of the shareholders. Again, protecting it kind of almost from the other way around. So really understanding the structure of a buy-to-let, it means that we can look at pretty much everything, certainly Kent Reliance. So in this case, you could have son or daughter with 100% shareholding, for argument's sake, of this limited company. That's absolutely fine for Kent and for Precise. You could have a small shareholding from son or daughter. You could even have one of the shareholders as foreign national living in a foreign country. As long as they're a minority shareholder, again, that's a deal that Kent Reliance can have a look at. What you'll find with buy-to-lets is there's different structures of ownership. You're going to come across cases that are a bit more complex. The way you can find this out, jump onto Companies House and it will list everything that's happening with it. And that's when it's the point to pick up the phone to us, have those conversations, see where we can support you. Okay, so we've done personal ownership cases. We started to look at limited company. Then you might be in a position of looking at portfolio landlords. So a big part of the marketplace, very much affected by the PRA changes, so the Prudential Regulatory Authority looked at the way we were underwriting landlords, if you like, especially if they had 4 or more mortgaged buy-to-let properties. So that's the kind of definition of a portfolio landlord. That's going to affect the way we look to see if that landlord's portfolio is under any pressure. This is a good thing, in my opinion. It shows that we're looking at what's happening in the background. Interesting to kind of let you know to a certain degree, although it pains me to say so, there are lenders that don't abide by the PRA rules. They are not regulated by the PRA, and therefore you may hear lenders saying that they are only concerned with the subject property that's going to them. So we are a PRA regulated lender. We are looking to make sure that that landlord is in a position of being able to cover those rental voids. But there could be other lenders out there that don't need to abide by those rules, and therefore literally will just look and say, right, it's 75% LTV, it's a great rental income, we move on. Whatever's happening in the background is not a concern for them. It is for us. So we've got a simple calculator to support you with that. Again, we're looking at the portfolio value, we're looking at the outstanding mortgages, we're looking at the rent, and we're looking at the mortgage payments. And we're also looking to see if it's a limited company structure or personal ownership. Depending on which one it is, again, just means the stresses and strains on the background portfolio are going to be either higher or lower. Again, coming back to those ICR calculations again. So if the one that's coming to us is a limited company, it just means we're not putting as big a stress as if it was in personal name, because obviously you can't start offsetting that mortgage interest anymore come January 2022. A few more questions to be answered as well. So again, big opportunities in my eyes, because it means for a portfolio landlord, you need to know what's happening in the background. So you're going to see if you've got opportunities for remortgages, what types of properties have they got. I had one recently where I think they had 5 or 6 2-bed flats, and the next one was, it was beautiful. This property was absolutely stunning, out in the middle of nowhere, but ultimately completely different from the rest of their portfolio. That's going to make us nervous. We just need to understand why the change in business plan, and that's why this kind of documentation could be really useful for us as lenders, but also from you, from an advisor perspective, to go, this just doesn't make sense. Is this looking more like a backdoor residential deal than it is necessarily a buy-to-let? So again, things to consider. So then you start looking at, right, I've got maybe a residential property. I've got a couple of buy-to-let flats, 2-bed flats, for instance, but actually I'm looking to increase my yields. How am I going to get more bang for my buck, if you like, by going down a slightly different route? And that's where kind of HMOs and multi-units have really come into play. Lots and lots of changes within the HMO world, lots of changes within licensing requirements, if you like, and lots of ways, I suppose certainly even through the pandemic, where landlords have gone, is this going to work for me? Am I looking to sell my HMO because there's too much licensing in place? Is it the right time for me as a new landlord to get involved? Again, flip side of that, lots of lenders are now looking to support maybe a first-time landlord that is happy to buy their first property as a HMO. So Kent Reliance, for instance, they would look for a first-time landlord. They could buy a 6-bedroom HMO, no problem. For a more established buy-to-let landlord, they can look up to 10 bedrooms. So you can see where, again, the market has changed a little bit, getting more comfortable with people buying HMOs as their first investment property. But again, maybe just limited the amount of bedrooms that are in place. So definition really important. So Google is a fantastic place. It will give you the answers that you potentially need, but ultimately understanding and defining what a HMO is going to be really, really important. So a house in multiple occupation, HMO, a property rented out by at least 3 people who are not from the same household. So example, a family. But shared facilities like a bathroom and kitchen, and that shared facility bit, really, really important. So Google what HMO is. If you're really feeling or struggling to sleep, the Housing Act 2004, about 350 pages. It will define exactly what a HMO is, and it will give you the kind of solutions. Lots of kind of misconceptions, if you like, within the mortgage industry about exactly what we call it. It's definitely 3 that are not from the same household. Again, just to bring that to life a little bit. So you've got 1 household, 3 siblings living together. So that's 1 family. That is not a HMO, but ultimately 3 households, so 3 unrelated friends living together is definitely a HMO. So 3 people, 2 separate families, in this case 3 separate families, that is defined as a HMO. I think where the confusion comes is potentially mandatory licensing versus the definition of a HMO. So again, mandatory is 5, but ultimately from a definition perspective, it is 100% 3. 2 households, so 2 couples living together. So you've got 4 people, 2 separate families living together. That's going to be a HMO by definition. And this is quite an interesting one, the last one. So you've got 1 couple and 1 single unrelated person living together. So 3 people, 2 separate families. Again, that's a HMO. Why I say that's an interesting one is because if you imagine you've got, say, a flat or a house that's got 2 individuals living in it, and then one of them decides to move boyfriend, girlfriend, fiance, whatever it might be, into that property, you're going from it being not classified as a HMO to suddenly being a HMO, and that could have detrimental effects to the licensing in that particular area to actually go, well, the landlord actually can't allow boyfriend or girlfriend to move into it because it could have a detrimental effect to the ability for them to let it out in that current state. Again, we'll cover that as we go through. So things to look at. So I mentioned sometimes within the industry, we get caught up with maybe the definition being 3 or 5. So again, if you've got a property that's rented to 5 or more people from more than 1 household, then you're going to need a mandatory license. So that's where sometimes that confusion lies. So I think just to break it down a little bit, you're looking at definitions, you're looking at licensing, and then you're looking at planning. And that's the bit I'm trying, it's difficult, but trying to get across to you within these slides. Now, the important bit is that that's affected a lot of people. So nearly 220,000 HMOs have been affected by these mandatory licensing laws. And that's really where landlords have made that decision point. Do I need to get out of the industry, or do I need to change things around my property to make this safer for my tenants? So that changed on the 1st of October 2018. Defined exactly what the HMO was. Interesting that it no longer was a requirement to be over 3 stories. So what did that do? Brought in flats, brought in bungalows, brought in anything, pretty much anything that had the definition involved. It just didn't mean that ultimately, I don't know, you had a big townhouse in central London or Birmingham, for instance, it wouldn't be affected. It now absolutely would. Again, local authorities then became more powerful, if you like. So those new licensing applications were made for the local authority, and that's your kind of key point. Again, going back to right at the start, we look at why someone's looking to invest and who's going to look into that, to renting that property out. That's where your local authority is going to play a crucial part in you understanding whether there's a deal to be done or not. So room sizes became really important. It really kind of tried to really understand who's going to live in it and how safe that's going to be to avoid those kind of ugly scenes of pretty kind of horrible, squalid conditions of properties. You've got RICS guidelines, you've got local authority guidelines. They do differ. Again, pick up the phone to us because Kent Reliance might look at it slightly differently than a precise case, for instance. We might look at Connells, for instance, for our valuations, whereas again, I think Brighton is a prime example. They have different licensing laws to RICS valuations. So again, they're comfortable giving a license on a property where the room sizes might be a bit smaller because they've got that experience and they understand the areas and they've controlled their areas a bit better than some of the other places in the country. Communal living spaces, I would say, is really important for my group of lenders. So for Precise, Kent Reliance, InterBay, communal spaces are pretty crucial. So that's where you've got a lounge, kitchen diner, whatever it might be. You've got the ability to have a shared space. You might find you've got HMOs where they're bed sits. You've got kitchen facilities within a bedroom, en suites in every bedroom, and there's just no communal space whatsoever. Might be a deal we can consider at InterBay, but again, they're ones to just have those conversations with us first. We must make sure, certainly at Precise in Kent, is that we're putting that property back to a family home, if you like, or a residential property if we were to take it into possession. That's probably the easier way of me describing how we would assess a HMO. It's not to say we wouldn't look at the increased rental income right now, but ultimately, if we were to take it into possession, what would it look like when we did take it back? So again, just that's kind of the easiest way of describing it. Any queries or questions on it, though, you can get in contact with any of our business development managers. So HMO licensing. So you've got your like I say, you've got your planning, you've got your licensing, you've got your definition. So again, this is where it gets a little bit more complicated, but selective gives the local authority a lot of power. It could mean that they can basically put selective licensing into any area, which means you need to apply for a license regardless of what your property is going to be. Then you've got your additional, then you've got your compulsory. And again, this is where understanding where the property is crucial to know how you're going to get to a lender to give that kind of best advice, if you like, or where you're going to go for that particular mortgage. So they're the steps I would take. Define it, then decide what type of license do I require on that particular property, and then start looking at, does it need planning? So define it, license, then planning. So understanding, is it selective, is it additional, is it a compulsory license because it's got 5 or more people comprising more than one household, for instance. Again, just understanding this crucial part. And it's to stop things like this. I know it's pretty grim, it's nearly lunchtime, but ultimately this is what we're trying to avoid, is these horrible, horrible properties that really just aren't suitable for anyone. So again, the licenses is really important. That's how the local authority can gain that control back in certain areas. Safety as well, really important. So when you get that license in, they're going to be looking at the fire doors, they're going to be looking at the smoke detectors, they're going to be looking at the emergency licensing, they're going to look at how you can get out of the property, they're going to look at, is it safe for that particular tenant to be living in that property? That's all it's about. Licensing is just about making it safe for whoever's going to live in it. Understanding again that you understand exactly if it's a mandatory license or not, really key. And then you've got to decide, right, okay, so let's, in this example, you've got a property that's rented out to 5 or more people. We know that's going to need a mandatory license. But then you've got another department to go to, which is your planning department. Now, bizarrely, and you might not think this is right, but your planning department and your licensing department do not talk to each other. So you might find you've got a client that's got a full license, can provide you with a license, and you go, yep, brilliant, fantastic, that's all I need. I now can go to the lenders that will allow me to do that. But you're going to need to find out whether they need planning as well. So is it that they've maybe taken, you and I would live in a C3 classification of property, but we need to understand if it's going to a C4 or it's going to one of these, what we call sui generis, which is your large HMO properties. So that's the key bit. Does it need that planning application to get it to that next classification of property? Then you're going to work out, okay, so I've got my HMO property. It's a 2-bed flat. Is that, yes, it's defined as a HMO. I've got that in my head, right? Okay, so I've got that in my head, it's defined as a HMO. But does it need full planning application? If it's in Scotland, unfortunately, it's a yes. If it's in what we call an Article 4 area, where that local authority is taking complete control of an area to understand whether they want more HMO properties in that area, then yes, you're going to need to apply for planning permission. If the flat is in England and Wales and is not, in England, and is not in an Article 4 area, then again, it's a no. You're not going to need that because there's no Article 4 in place. It's not a mandatory license because it's not above 5. So again, just understand a local authority where the landlord is looking to invest, giving yourself time will support you with these types of applications. So just bringing this to life a little bit, big Article 4 area in Birmingham here. You can see the red line kind of really highlighted how they kind of tried to control an area of the city. So they brought in this Article 4 area to see what they could do. They did allow a bit of a consultation. So in essence, if you had a property within this, they would allow you to continue it as long as they saw that application come in. But then they started to make it bigger. So it really did, I'll go back one slide there. So in essence here, the slightly shaded area towards the bottom, that was that tiny area. Now the whole of this black line that goes around the city is the whole of the Article 4 area within Birmingham. So really highlighting they've taken full control of every application and every type of landlord that is looking to do a HMO property. From a criteria point of view, again, first-time landlords I've mentioned up to 6 bedrooms Kent, but we can do up to 10 bedrooms if they're an experienced landlord. Limited company structure is not a problem. We've mentioned age before, we can do up to 80%. Valuations is a neat point, so very much the same as a core buy-to-let with Precise in Kent. For the larger HMOs, it could be for Interbay Commercial, for instance, we could go down what we call a long form valuation, which is a more commercial valuation that gives us more flexibility to go, actually, you might get a higher commercial valuation than you would do a standard one. Again, anything above 10 bedrooms, just give us a call on it, see if there's a deal to be done with someone like Interbay on something like that. And then last couple of bits from me is just to say, talking about diversification, it could be even into holiday lets. So where you've got someone that's looking, and I think this, what was my latest stat? I think we've gone from about 13, 14 lenders that were lending into holiday lets to about 27 lenders out there now. It's a growing part. Obviously, we've been for a lockdown. Lots of people seem to like holidaying in the UK at the moment, or not by choice. I think the interesting stat is even in 2018, so pre-pandemic, there was still 66% of us that were holidaying in the UK. So this is still a strong part of our economy, and it could still be something that you're aware of, something you can look to do, something that landlords are continually looking to support as well. From an Interbay perspective, and Interbay is the only part of our kind of branding, if you like, that lends to holiday lets, we can allow this to happen in a limited company structure or in personal name. And we're one of the only lenders that does allow it in that limited company structure. So again, giving you a bit more flexibility. Most holiday let providers will do it over a kind of seasonal average. So they go a 10-week high, 10-week medium, and a 10-week low. And that's how they look to see whether it's going to be a feasible transaction for us or not. Standard valuation, and lots of lenders insist on it being a holiday location. So weirdly, it does rule out things like London, because it's not deemed as that kind of long-term holiday location, but more short-term lets. We do allow a landlord to live in the property for at least 60 days a year. Some are more, some are a bit less. Interestingly, though, we do only have a 30k minimum income requirement, and that can be across 2 applicants, for instance, with some insist on that being against 1. And we do want a little bit of experience as being a landlord, so at least 1 buy-to-let in the background for at least 12 months. EPC rating, just want to finish up on this one, just to make sure that this is something to keep you kind of be aware of. There is a lot of talk about this going up to a C rating, and it's really going to be an interesting next couple of years to see if that does happen or not. At the moment, an F or G is a fail. You might find you get landlords looking at properties that are those F and Gs, but really, if it goes towards a C, there could be lots and lots of opportunities, also threats, with people looking to buy properties that are failing these EPC standards. It could be you get an influx of landlords that are looking to sell their buy-to-lets. Where are they going to sell them to? Could that be an opportunity for first-time buyers, for instance, to come into the market, pick those properties up? It's just a difficult one. It's one to keep an eye on. Like I say, they're looking at putting this rating up to a C come 2025. Nothing signed off as yet, but it's coming, and there is a lot of talk in the industry about it. Again, where do I get the money to improve my property to that rating? Can I do it? Is it possible? Or am I looking to say to sell it? Again, something to have in your mind if you are talking to a landlord that's looking to remortgage. Because ultimately, if those rules do come into play and you've just fixed them in for, I don't know, 5 or 10 years with a lender, that could have a massively detrimental effect to their kind of property going forward. So things to be aware of, things to just show that you know that knowledge, you've got that knowledge in the background and can support in what you're trying to do. As will these guys. So our sales teams across Precise, Kent and Interbay, all there to support you. all there whenever you need them to have these conversations and see if it's a deal for us or not, or potentially just lean on for advice and support in how to structure these deals correctly. So yeah, we've covered a lot today, Becky. We've looked at a number of areas across the more complex part of the buy-to-let sector. I hope you've digested it to a certain degree. I've forgotten pretty much everything I've said already, but hopefully it's given you a little bit of a flavour about the opportunities within the marketplace. But Becky, I'll hand back to you. If you've got any questions, I'm